Take a look at the headlines and you would think the economy is booming. Stocks are at record highs, job numbers look strong. But that's not the whole story. While the S&P 500 was breaking records in early 2026, some of the smartest investors in the country were buying businesses built around one thing: people running out of money. And maybe that tells you everything you need to know about this economy. Because when the rich start investing in pawn shops, they are not betting on prosperity. They're betting on desperation. Chapter 1. The Illusion of Stability. On the surface, America looks healthy, unemployment is low, and wages are creeping up. The middle class is stable, but that's not exactly true. As of early 2026, the Federal Reserve placed U.S. credit card balances at roughly $1.28 trillion, with the figure climbing in the mid-single digits each year. That's happening while employers report stable payrolls. Consumer sentiment is collapsing under the weight of everyday costs. Grocery, fuel, and utility prices have outpaced wages in the middle of the income ladder. None of that shows up in the jobs report, but it shows up in the pawn shops. The biggest operators reported record service charges through the second half of 2025. That trend continued into early 2026. Even foot traffic in suburban strip malls is climbing again. But the most revealing part is what people are actually doing inside of these stores. Between 80 and 90% of pawned items eventually get bought back. That suggests most of the customers have steady jobs and are using the loan to bridge the gap between paychecks. You can open the Wall Street Journal and see the headlines screaming "strong economy" and "stable labor market." Meanwhile, in the same week, household finances are crumbling, paychecks are still arriving, but the cash is disappearing faster than it comes in. So if the paychecks are arriving, why are families pawning their possessions just to get through the month? Chapter 2. The Invisible Outperformer. FirstCash Holdings runs more than 3,300 pawn shops across the United States, Latin America, and the United Kingdom. Over a 12-month period ending in April 2026, the stock roughly doubled. It went from the low 120s to a high of $227. The S&P 500 returned a fraction of that over the same window. It is the kind of run you would expect from a frontier AI lab or biotech, not from a chain of storefronts whose median transaction is a loan against a watch. FirstCash reported first quarter 2026 revenue of just over $1 billion, a 26% jump year over year. The pawn loans on the balance sheet hit a record $851 million, and total assets crossed $5.4 billion. It is a sign of a booming business. The company even raised their full-year 2026 outlook after the late April update. That saw the stock surge higher on the news. The fastest-growing item inside FirstCash Holdings isn't the resale of pawned goods. It is the loans themselves. Not what gets sold, but how fast the debt against household property is growing. That is what the market is rewarding. Compare that to a tech company. The growth usually comes from new contracts or expansion into new countries. The thing being scaled is software. Here, the thing being scaled is desperation. A $150 drill set gets pawned to cover a car repair. Do that thousands of times across suburban storefronts, and you arrive at a margin profile a software company would envy. It's a steady stream of short-term loans backed by everyday items. The chain of pawn shops is starting to look like Nvidia on a price chart, and Wall Street has noticed. They assume the loan book keeps growing, and that is the tell, because it only works if more people keep needing short-term cash just to get through the month. In other words, the growth story isn't about expansion anymore. It relies on the middle-class strain continuing to show up in the numbers. Chapter 3. The Rolex in the Suburbs. The picture most people carry of a pawn shop customer is decades out of date. It involves an inner-city storefront, a neon sign, a row of dusty guitars, and a clientele the banking system gave up on years ago. That is not the case. The ticket sizes are changing, and so are the customers behind them. Employed families are showing up more often. Women are pawning inherited jewelry. Small business owners are arriving with Omega and Rolex watches, while tradespeople are bringing in their tools. Some of those are worth $1,000 and some hit $3,000 in a single visit. Today's customers have pay stubs, they have 401ks, but they're still walking through the door because at the end of the month, the numbers don't add up. Middle-income households earning between $60,000 and $100,000 a year now make up a meaningful share of new customer growth. Many use the loan to cover a mortgage payment. Some small employers use it to make payroll on a Friday when an invoice is late. EZCORP is the second major publicly traded pawn operator, and its second quarter fiscal 2026 numbers almost defy belief. Total revenues climbed 46% to almost $447 million. pawn loans hit $349 million. The average loan amount jumped from $160 in 2022 to $240 in 2026, a 50% increase in just 4 years. Even the jewelry scrap side of the business rose by 64%, helped along by increasing gold prices. Gold prices are sitting near multi-year highs, which means operators can lend more against fewer items. A wedding band that would have brought $180 back in 2023 might pull $320 in early 2026. This invites higher value collateral through the door, and higher income borrowers have started to show up. A pediatric nurse in Phoenix walks in on a Tuesday with her grandmother's tennis bracelet. She's not in crisis in the dramatic sense. She still has a steady job and a normal life on paper, but her air conditioning just died, her credit card is maxed out, and a bank loan won't clear in time. She needs $400 by Friday. Across town, an HVAC contractor walks in with a snap-on socket set. It is worth thousands of dollars. He needs $900 to cover a payroll gap. Nothing is wrong with his business, the timing is just off. Both of them end up in the same place. If people with jobs and assets are increasingly using pawn shops to bridge short gaps, it's not really a question of employment, it's a question of timing. That's why this whole industry is growing. Chapter 4. The Banking Desert. Walk the main drag of almost any American suburb built between 1970 and 2000, and you'll see the facades of banks. In their place are nail salons, pop-up shops, or for-lease signs. Where there used to be a regional bank with a drive-through and a Saturday teller, there is a fenced-off lot waiting for redevelopment. From 2017 to 2025, the national banking network shrank by nearly 15%, dropping from roughly 86,000 branches to about 73,000. More than 900 bank branches closed during the 2024 calendar year alone. 16 of the largest banks accounted for 800 of those closures. The 2025 figures show another several hundred branches gone. The geography matters more than the number. The Philadelphia Fed has found that from 2019 to 2023, the U.S. lost roughly 5,400 bank branches, with the highest absolute number of closures occurring in middle and upper-income suburbs. But proportionally, the damage was devastating elsewhere. Low-income and majority-black neighborhoods saw branches vanish at a significantly faster rate, rapidly accelerating the creation of banking deserts. Take a place like Lithonia, Georgia, a middle-income suburb southeast of Atlanta. Between 2020 and 2025, branches across DeKalb County steadily disappeared. Wells Fargo locations closed, so did Bank of America and Truist Financial. The traditional banking footprint shrank, but the pawn signage along Highway 124 has not gone dark. It multiplied. That same pattern repeats in suburbs across the country. Banking deserts, areas without a bank branch within a reasonable distance, grew between 2019 and 2023. And in the places that were hit, access didn't just disappear, it stretched. In those affected neighborhoods, the median distance to the nearest branch increased by roughly 1.5 to 2 miles compared to just a few years earlier. That means the nearest option for quick in-person banking kept moving further away. And for a growing number of households, that gap gets filled somewhere else entirely. The same suburban corridors that lost their last walk-in branches are the corridors where pawn loans expanded the fastest. One form of lending was pulled out of those zip codes at almost the same time another form was put in. Chapter 5. The BNPL Gateway. There's one stop most middle-class households make before they ever reach the pawn shop counter. It doesn't look anything like a lender. It looks like a checkout button. Buy Now, Pay Later was sold as financial inclusion, 4 easy installments and no interest if you pay on time. It's an easy way to spread $300 purchases across 2 paychecks. The big 3 players are Affirm, Klarna, and Afterpay. Affirm alone processed more than $34 billion in 2025. Klarna now serves around 150 million active users globally, and meanwhile PayPal, Apple, and even Amazon have all rolled out their own pay later options. The space went from a niche feature to a default option in roughly 5 years. The Richmond Fed has tracked the growth of the category, with transaction volume climbing at high double-digit rates each year. A growing number of purchases are through installment plans that mostly skip the traditional credit bureaus. These apps generally don't run hard credit checks, but they do report back to the major bureaus and run soft credit checks. But it still means a shopper can stack 4 plans across Affirm, Klarna, Afterpay, and a store card. The Consumer Financial Protection Bureau has flagged the pattern. BNPL users tend to carry higher balances on credit cards and personal loans than non-users. Late fees pile up, repeat usage increases, and eventually the household hits a wall. When the BNPL limits get used up and credit lines tighten, there is one obvious place to turn to. A growing share of pawn customers seem to be coming out of households that leaned heavily on buy now, pay later first. A pawn shop doesn't report to bureaus. It doesn't care about credit history. It just cares about the loan. But if this is really the growth story, the next question is obvious: who actually owns it? Chapter 6: The Institutional Landlords. Behind the storefronts, the ownership structure looks very different. FirstCash Holdings is roughly 80% institutionally owned. As of February 2026, the Vanguard Group held around 9% of the company, worth roughly $650 million. BlackRock has a similar amount. Below them, there are hundreds of smaller investors. These are the same firms that manage your 401k. Money is flowing in two directions at once. The same firms helping people save for retirement are also invested in companies that make money when households run short on cash. On one side, they manage long-term savings. On the other, they own pieces of businesses that step in when someone needs $300 or $500 in a hurry. Nothing about this is hidden, it's all public, but it creates a strange overlap. The money that's supposed to protect your future is sitting in the same system that profits when things get tight. And that is the part that doesn't feel obvious until you say it out loud. Why are the biggest asset managers in the world putting billions into a system that seems to profit when their own retirement clients are under pressure? Chapter 7: The Yield Trap. Pawn shops don't look expensive until you look at the fees involved. Depending on the state, pawn charges work out to roughly 60% to 240% APR. A typical credit card usually sits in the low 20s. That's not a small gap. That means a $500 loan against a wedding band for 90 days can generate around $300 in fees and interest. A bank loan for that same $500 over the same period? About $15. It is the same money and the same time, but a totally different cost. Most items in the pawn shop, around 80 to 90% of things, get redeemed by the customer, so the collateral usually comes back. But the fees don't, they're locked in. And that means the same customers can cycle through the system again and again, each time paying for speed and access. There's another advantage to this system. In many cases, it doesn't show up on your credit file. It doesn't run through the same approval system. It follows different rules entirely set by state pawn laws, not traditional lending standards. Put it all together and it becomes a very specific kind of business. It's fast cash backed by something you already own. The result is a market that keeps growing, not because people are buying more luxury items to pawn, but because more people are using the same items again and again just to get through the month. But when you look at all this, a different pattern starts to appear. A two-tier financial system that has been constructed while most of the attention was elsewhere. Chapter 8: The Great Decoupling. The top 20% of borrowers still live inside the old financial system. They have savings accounts, mortgages, credit cards, investment accounts. For them, banks still feel like banks. But below that, something else has quietly formed. One that is faster, one that is more expensive and doesn't help you build wealth over time. It just helps you get through the month. And it shows the divide. The executives running parts of this system don't really talk about it like a problem anymore. They take the money troubles of regular people and they call them a boost for their company. When they buy up more businesses, they call it a chance to grow. The original American dream relied on banks that actually wanted to keep middle-class families as customers. Now those families are viewed as just another way to make more money. The system is already set up for this, the money is already moving, and the companies are already cashing in. Investors are backing pawn shops because the profits aren't coming from new products or new customers. They're coming from the same households the system once claimed it was designed to support. And if that's the direction things are already moving, the next question is obvious. What happens when the system stops completely? Find out in What If the US Economy Crashes? Or watch this instead.